we're just recording what we're doing here in class. Let's see. Problem 17-32A. Okay, so it says, Howie Stars produces stars for elementary teachers to reward their students. So I guess it's like those stickers. This company makes these stars, okay? And they give us our June 1st trial balance. And from Accounting 202, you're probably pretty familiar with what a trial balance is. It's listing all of the accounts that we have and the balances that are in those accounts at the beginning of June. So it looks like this is still the closed out accounts from May, because I notice my revenues and expenses are zero. Okay, so we haven't had any activity in June yet. There are some retained earnings, so that would end up being the beginning retained earnings. Okay, so let's see what they want me to do. June 1st balances in the subsidiary ledgers were as follows. Okay, so they're giving us, let's kind of analyze this a little bit, right? I think what they're doing is they're just giving us the inventory balances, right? I notice raw material, work in process, and finished goods. So what they're saying, that raw material balance in the trial balance, 5,600, raw material, is made up of 4,700 in paper and 900 in indirect material. Okay, because 4,700 and 900 equals 5,600. But I'm just going to double check that to make sure. Okay, so I got a work in process master account with 41,300, and that's made up of job 120 for 41,300, and apparently they've started job 121, but they don't have any costs moved into that job yet. Okay, so that's why it's zero. So that ties out 41,300, and then finished goods is see, what they end up with is they take this paper and other indirect material and labor, and they do these jobs, and they end up with jobs that are made up of large stars and small stars. Okay, that's the end product: large stars and small stars. So they got 8,900 in large stars and 11,100 in small stars. So what would that be? That would be 20,000. Yeah, those add up. Okay. So that's what they're giving me here. It says, now we got to do some journal entry, right? And the first entry is an accounting 201, right? Financial accounting entry. It says we collected 152,000 on account. So kind of a refresher. We're collecting cash, debit cash, 152,000, and we're actually collecting an account that's owed to us. So we're going to reduce accounts receivable by 152,000. I might be able to get some of this out of the way until I need it, and we got a good job on that. Okay. And then it says selling and administrative expenses incurred and paid 20,000. So I'm probably going to debit selling and administrative expenses, and the word paid means that I used cash, so 20,000. We all should probably have a handle on this. If you, I know it was a long summer, so you might have not remembered that from accounting 201, but so this should kind of trigger your memory. Okay, and then we make a payment on account. So you know, when we pay an accounts payable down, accounts payable has a normal credit balance. We have to debit the accounts payable. So this is going to be a debit to accounts payable, 40,000, and of course cash is an asset, and when we use cash, cash decreases, so we're going to credit cash, 40,000. So far so good. Yeah. Okay, now we're in a closer to doing some managerial accounting here. Materials purchased on credit. So we bought paper, 26,600, and indirect material, 41,000 or 4,100. And they want me to prepare a single journal entry for this event. And it was on credit, so that means accounts payable is going to increase. So let's see how they break down. See, notice there is no paper account and there is no indirect material account. We're just going to stick it into our raw materials inventory. Okay, we'll scan through real quick, make sure that we don't have those two accounts. But it makes sense because we put all of that material that we're going to use in the product into that raw materials inventory account, right? And then we have an accounts payable. So we got to add, right? So we got 30,700. If I did my mental math correctly. Make sure. Does everybody see how I did that? Okay. So even though it's paper and indirect material, and even though we might need to know this for later, we're going to stick all of that into the raw material inventory, because that's the inventory account that we set aside for use, right? We're going to take things out of there to actually make the product. So as we start a new job and we need material, we're going to move that material out of raw material and into work in process. Now the indirect material is going to go to a overhead account before it comes to work in process. Okay. Let's see. Material, okay, so here, I kind of spoke before I needed to, but this is where we apply it, right here in the problem. Materials requisitioned and used in production. So when you requisition materials, you send internally, if your company's set up with all of these processes in place, you're gonna, there's an example of it in your book, there's a requisition slip. That would be the manual way to do it, but you're gonna send a request. That's what a requisition is. You're requesting material to be used in this job, and then you know how departments are, they'll send it over and there's a record of this transfer of goods. Okay, so we're requisitioning for job 120, paper 500, job 121, paper 7,950, and indirect materials. And they want a single entry. Okay, so my entries are kind of at the master account level. We're not really down in the detail. Okay, so I'm going to add the paper, because those are direct materials. We know exactly how much paper we need for each large star and each small star, which is our end product. Okay, so I'm going to put those two directly into work in process. Okay, so I got 8,450. That's correct. If I add these two, the 500 that's going to job 120 and the 7,950 that's going to job 121. Okay, and then the indirect material goes to an account called manufacturing overhead. Okay, so those two accounts are increasing. Okay. Manufacturing overhead is where we keep all of those costs that we can't directly tie to each unit. Right? There's not a incremental relationship with each unit. Right? It's not like we need one sheet of paper to make 10 stars. That's a direct relationship. Indirect material would be something like, in the case of stars, I'd have to really think, but it would have to be something that doesn't have that direct unit per unit tie. Or maybe you guys can come up with something. Indirect material. Anyway, think about that, okay? That's the idea. So it's all coming out of raw material though. So the raw material inventory account is going to decrease. So again, we got to do some math. We got 9,950. Did you guys double check the math? So I don't embarrass myself as if I can't add here. Let's see. We'll just take a chance. Oh, we did good. Okay. Thank you for checking. So you see what happened, right? If it's direct, it's going to go right to work in process. It's going to right to those jobs. We can directly tie it, right? If it's indirect, we're incurring this cost, but we don't have a direct relationship with the job. But it's still part of making these stars. Okay, so it's still a cost involved. Any indirect cost, we dump it into overhead. Okay. Now, wages incurred in June, labor time records for the month. This one's a little more clear as far as what's direct and indirect, right? Of course, if you're working on a job, that's a direct labor cost. So any time spent directly on job 120, we can track that. And it's a little easier to track because a lot of people will be punching in, or they'll punch in a charge code and charge their time to a specific job. Okay? So we got job 120, 3,750, and job 121, 17,500. That's going to end up being our direct labor. So we will put it directly to work in process. So notice now the labor is actually becoming part of the inventory's cost. That's a great point to make right here. What are we doing? There's a word for that. We're capitalizing the labor costs. Whenever you capitalize something, that means that you're making it part of the cost of the asset. So labor is actually becoming part of the cost of our inventory. That labor cost is going to end up in the finished goods inventory, the product that we're actually going to end up selling. So you might have to help me now. I got 20, do I have 21,250? Double check that. If I add job 120 and 121, roger, okay. And then my overhead, see, anything that's indirect gets accumulated in manufacturing overhead as it's incurred. 16,750. Okay. Now, you know, there could be a intermediary step in this where you accumulated it as payroll expense and then you moved it out of payroll expense and stuck it into the jobs, but I believe they're putting it directly in there. So it's probably going to be something like salaries and wages payable, or let's see what kind of accounts we have. Accounts payable, cash.
Wages payable.
You see wages payable? Yeah. So you can use wages payable. So they were able to charge it directly. Now we got to add these bigger numbers. So I got 37,100. Yeah. Let's double check it. 38, right? 38, right? All right. How's it? Okay. We're looking at problem 17-32A. If you wanted to work yours, that's part of the reason I made it in the lab too. If you want to work yours and get it done, either way. I got a daughter and she wants to do everything herself, so it's like she'd sit there and take notes and then go home and not ask for any help, kind of thing. So it just depends on how you like to approach this. Okay, so let's see. Wages paid in June include the balance in the wages payable account at May 31 plus 36,500. So this May 31 should trigger something in your head. I gotta go look at where's that May 31 balance? You see where it says May 31, right? Well, May 31 is really the end of the last accounting period, right? So this, when you think about the June 1st trial balance, those balances are what we ended at on May 31. So you think of, if you took a work day, right? May 31, 5 p.m. will be the same as June 1st, 8 a.m. when work starts. Okay, so that balance is just rolling over. So my May 31 wages payable is going to be sitting in this June 1st trial balance. So let's see. Where is my, there it is. 1,800. Okay, so what they're saying is we're going to be, number one, paying down that liability. So notice that's a credit balance. we're going to have to debit wages payable for 1,800. And at the same time, we're going to have to debit the wages expense, right, for 36,500. Okay? If I read this right, let me read it again. Wages paid in June include the balance in wages payable on May 31st plus 36,500 in wages incurred in June. So I believe I will do that. I will go there's wages payable, right? Wait. Okay. Wages payable, 1,800. You know, maybe it's all sitting in wages payable because I don't see any expense to book it to.
What says they're added up to?
So they're all sitting in wages payable.
Yeah.
That's probably the way it is, right? So let's see, 36,500 plus 1,800. What do we got here? Let's see, 38,300. We'll see if we get this right. So they're paying that down with cash. Let's see. Got it. Okay. Right. So they're basically paying off the liability, their wages liability, what they owe. Now, depreciation on the plant and equipment. Here's an example of an overhead cost. Because depreciation is indirect. Okay, I guess if you got really you split hairs and you spend a lot of money, you could make depreciation a direct cost. And that's kind of part of what that ABC costing chapter is about, is getting even more refined. But reasonably, depreciation is on that plant where we're making the stars, but it might not be just for stars. We might not be using that plant just for stars. It could be used for all kinds of other things. So we don't really have a direct tie to each unit that we're making, each end product. In this case, it's stars. Okay. So I'm going to stick that into overhead. Manufacturing overhead. Okay. And then what's the offsetting side of depreciation? We'll make accumulated depreciation. Okay, now I'm going to do a little side chart here for you. See, this is the overhead account. Let's kind of do this real quick. You should have these diagrams in your book too. Okay, you got manufacturing overhead. And what happens is it accumulates on the debit side and it gets allocated or reduced on the credit side. Okay? So as we incur overhead, we increase on the debit side. Okay? And then as we move it out of overhead, we're going to credit it. Okay? Now the overhead gets allocated to work in process. Okay? It's going to move from overhead to work in process. Now the thing is, we're going to be allocating, okay, so overhead is allocated using a predetermined rate. I'll pause there. Okay, so that's your overhead rate. That's a rate that you come up with to take overhead out of the overhead account and put it into each job, basically. And on a higher level, on a cumulative level, right, you're actually increasing the work in process account. Okay. The thing is, we start allocating before we've accumulated all of the overhead. Because these jobs start, right, a lot of times before we've incurred any overhead costs. So we don't necessarily know exactly how much overhead we're going to incur when we start allocating overhead. Okay. That's why this is an estimate. It's called a predetermined rate. So we come up with this predetermined rate, probably thinking when we do it, what's the closest relationship that each job has to the amount of overhead it uses? So how would we do that? We probably would look back historically and look at what each job actually did, how each job actually performed, and use some percentage that way, some relationship that we can come up with. The book in this case uses direct labor a lot. So they say, okay, for every hour, this is just an example, for every hour of direct labor, we're going to move 50 cents of overhead. Okay? And they probably did some sort of study, and in the past, it appeared that that's a close enough number. 50 cents for every dollar of direct labor comes out to be what the overhead cost is. Okay? So we're moving it out of overhead and into work in process. Okay? And what I can say is, right, we'll make a note. Note, the allocation often happens before the overhead costs are incurred or simultaneously. Okay, I would say the former more so than the later in this case, right? You're probably going to be moving overhead either before it's accumulated, as it's accumulated, but not in complete type of thing. Okay, so it's a separate thing, right? The allocation and the accumulation. Okay. Let's pop back to our problem. So our problem is saying manufacturing overhead was allocated at the predetermined overhead allocation rate of 60% of direct labor costs. Okay, so what I'm going to do is I'm going to scroll back up here. I'm going to look for that journal entry where I had direct labor involved. And it's here, F, right? Remember we had labor cost of $3,750 to job 120 and $17,500 to job 121. Right here, if that highlight comes out okay. Okay. So I'll take 60% of that total. And it's actually totaled for me here on this line. So 21,250, and I'm not going to do this one in my head. I'm sure some of you can, but I'm just not there yet. Okay. So I'm going to take 60% of that, because that's the predetermined overhead rate, times 0.6. And that's the amount, 12,750 that I'm going to move out of overhead and put it into work in process. So now the work in process is absorbing some of the overhead costs, right? But notice it's just the rate that we came up with. It's not, there's no per unit association. There's not like 1 star absorbs 50 cents of overhead kind of thing. In a way, it could be broken down that way. Let's see.
So it's an estimation then?
It's an estimation. It is. It's something, that's why it's predetermined. It's determined before we actually figure out what overhead is. Yeah, predetermined rate. And then we just reduce the manufacturing overhead account with a credit. Let's see. Okay, we did okay. That's kind of a little abstract. Does everyone get that idea? you hear a lot about overhead rates, even in government accounting. Because what happens is they need different departments to absorb some of the overhead costs. Think about it. If a job didn't absorb some overhead, it might look more profitable than it really is, right? If only one job absorbed all the overhead and the other jobs didn't, then it wouldn't be equitable. Think about giving bonuses out, right? You're deciding, okay, well, oh, these guys did really good on job 120. The accountant came up with this report and it shows that they're so profitable. But then somebody might come in with a fine-tooth comb and say, hey, job 120, they didn't take on any of the overhead costs, right? And then the other jobs are going to get upset, or you'll be like, well, then you might have some infighting drama. Okay. Okay, now it's saying the jobs that were completed. So what we're going to be doing now is we're going to be moving jobs out of work in process and into finished goods. If these jobs are completed, then they're ready to be sold. They may have been sold already once they got completed. But let's see. So job 120, 800,000 large stars at a total cost of 47,800. Okay, so we're kind of fortunate here. We didn't have to go back and figure out what job 120 cost. They're just giving us the total cost. So all I really have to do is debit finished goods. So I'm increasing my finished goods inventory, and I'm going to credit work in process. I'll move it out of work in process. So it's no longer being worked on, it's done. The stars are done. Okay. And then now they're telling me job 120 was actually sold at the same time. So here comes the part that is accounting 201. Okay. So the first thing they want me to do is record the revenue. So be careful here, right? Because up until this point, our focus has really been, our mind's really thinking about the cost of these things. Now we got some revenue involved. Job 120 was sold for 111,000 on account. So if you remember, on account means that our customer hasn't paid us yet. We have an accounts receivable of 111,000. Okay. And then what do we have? When we sell something, we have, what's the main, I don't want to say the main thing in business, but what do you have to actually be in business? You have to be making revenue, right? So when we sell something, we got revenue, and because it's a good, the way academia does it is they're going to call it sales revenue, which is proper. Sales revenue, so that stresses the fact that we sold something tangible, or we sold inventory. Okay, so we've recorded the revenue side of this. And the problem says don't do the expense side yet, because the expense side is going to be the cost of goods sold. At least in the perpetual method, right? We record cost of goods sold at the same time that we make the sale, right? So in order to have cost of goods sold, right, you have to be taking the cost of those items out of the asset account in which they were sitting. So job 120 was sitting in the finished goods inventory account. Finished goods inventory is an asset, right? And the total cost of job 120 was 47,800. So notice it's sitting there as a asset, debit balance, 47,800. We're going to remove the 47,800 from finished goods inventory. We'll take it right out of. Okay? So I'll do a little refresher. What's the gross profit on job 120? Right? Gross profit is the difference between your revenue and your cost of goods sold. Okay. So you could do it in your head, or you could simply go 111 minus 47,800. Okay, so I'm taking the 111,000 in revenue minusing 47,800 in cost of goods sold. So I got a gross profit of 63,200. Okay, and then if you wanted gross profit percentage, you take the hard gross profit number and you divide it by the revenue. So basically take 63,200 and divide it by 111,000. And that will give you a fraction. So they got a 56.9 or rounded 57% gross margin. So for every dollar on that job, they got 57 cents roughly. Just kind of a refresher, we threw that in there. Okay, now we need to make an entry to adjust the over allocation or under allocation of manufacturing overhead. Okay, so let's take a look at what we got here. I'll leave those phrases there just for you. It actually would be numbers sitting here. And we'll make this smaller so I can show you what we're doing. We're going to figure out how much overhead. I learned that, like a year and a half ago, that you can drag these windows, bump them up against the side like that, and they'll fit themselves. I used to be over here like, okay, I gotta stretch this, but all you gotta do is just take it and boom, and then they fit there nicely. I thought if you don't already, you probably know that already, but let's see. Okay, so my overhead was accumulating. Let's see, let's look for any debit to overhead. Okay, here's one. So I got a $1,500 debit to overhead, and this was my indirect material. I'll just make a note there, right? So that's where it's accumulating. Then did I have another debit to overhead? Yes, I had 16,750. That was indirect labor. Okay, and then we'll scroll down. We're kind of looking for any activity in overhead. Oh, there was depreciation. Okay, 2,800. So this was plant depreciation. You see what I'm doing, right? I'm kind of posting, just looking at overhead. Okay, because what I want to do is I want to see how much was accumulated and compare it to how much was allocated. Okay, and I come down here. Okay, so that's, I saw an allocation going out. Okay, so I don't see any other overhead activity except this 12,750, and this is the amount that was allocated. Sometimes we use the word applied. Okay, either allocated or applied to work in process. So what you would do is you would find the balance. Okay, and everybody knows how to find the balance. We'll add up the debits. That's 21,050, and add up the credits and get the difference. Okay, so I'm going to just use Excel to do that because it looks like it's going to end up being a debit balance because there's more debit. Right? You can just see that eyesight. Just that 16,000 shows you right off the bat there's more debit than credit. So really, I'm just taking Excel, adding up the debits and subtracting the credit. So I got a balance of 8,300. So what this tells me is I didn't allocate all my overhead. So if you end up with a balance on the debit side, okay, in this case, that would be under allocated. Okay. Had you had a balance on the credit side, that would have been over allocated. But logically that should make sense, right? Because if we're crediting the account to allocate the overhead, and if we didn't credit enough, then we didn't allocate enough, right? So our situation shows me that we're short in our allocation by 8,300. Okay. Ideally you would hit zero, but you're probably never going to hit zero because why? Yes, the rate is an estimate, and it's being allocated before we actually accumulate the overhead. If we could, like I said up there, I don't think, maybe in theory you could be doing it simultaneously. But yeah, I guess you could allocate every charge as it comes in, but you need to get overhead cost into each job before you're actually accumulating it for the managers of those jobs to keep their finger on the pulse of that profitability. You know, make sure they're not going into the red, right? So that's why we're going to allocate prior to accumulating. Okay. So the way we're gonna adjust this off, and because this is an introductory managerial accounting course, we use the simple method, right? We're gonna adjust off any overhead, any under allocation or any over allocation using the cost of goods sold account. Okay. So I'll do this one over here. We're gonna take, see, we're gonna have to credit manufacturing overhead to get that account to zero. We all agree, right? By 8,300. So what we're gonna do is we're gonna charge cost of goods sold. So it basically becomes part, right? It's reflected in your gross margin. Right? It ends up in your net income. So it's still reducing net income. And then what we'll do is we will credit manufacturing overhead by 8,300. Okay. So had it been the other way, had you had a balance over here on the credit side, right? So assume you had a $5,000 credit balance. What we would have done is we would have debited manufacturing overhead and credited cost of goods sold, which doesn't look good. You know, your eyes are like, well, how come we're crediting cost of goods sold? You normally don't credit cost of goods sold. That's an expense account. It usually gets debited, but that's where the adjustment would be to get rid of the overhead balance. Had we over allocated. Okay. What would that do to your net income? This scenario, not the one in the problem, but had this scenario occurred, what would that effect be on your net income? The journal entry I got highlighted in gray. It would increase your net income because it's reducing an expense. It's reducing cost of goods sold. Keep your eyes out for that one. There might be something like that in a problem. This problem, when you redo it, it might tweak that way. I'll take that out of there just so we're not confused. Okay. So requirement number 2 here is posting. And this is the one that everybody says, oh, this is so tedious. Okay, so we keep making you do it because we want to make sure you're good at it. Accounting 201, 202. You want to be able to post correctly. Okay. I think the nice thing about it is it's going to give me I can just look at my journal. I don't have to scroll back up. So I can look at my general journal here and just start posting. Okay, so I'll just start posting and maybe I'll give a little narrative while I do it. See, what they're using as a reference is the journal entry number, which is in the date column. Journal entry letter, right? So that's A, and then accounts receivable, got the credit of 152. So good refresher. Selling and administrative expenses, they got debited. I'm on B now. B, and cash got credited. And if you don't recall, you don't have to skip a line, right? Our whole idea is just to list all debits and credits in each account. So there's no reason to come down here below A or anything. I've seen that though. And I can understand why somebody might think that, but it's just a T account. Okay. Now C is accounts payable. See, accounts payable got paid off. So we got, well, some of it got paid off. 40,000 debit, C, and cash credit, 40,000, C. And then we kind of work our way down. Raw materials inventory got a debit, 30,700, D now. And accounts payable got credited. Oops. We'll see if I get it right, because I'm talking and doing it at the same time. But let's see. D. E, work in process, got debited. You know, the other thing it seems like just a busy work task, but the other thing is, while you're doing this, in your head, subconsciously, you're remembering what the transaction was. Okay, so you're kind of reinforcing how to debit and credit these things. Did I mess that one up? Did I skip one? Ah.
You put F.
Yeah, and I used the F number, right? Ah. Maybe we cannot do two things at once. Let's see. E, 8450. Overhead, 1500. This one was a compound entry, and raw materials credit 99.50. Okay, now we're on F. And we got work in process again. Manufacturing overhead, 16,007. And wages payable, 38,000. Nicely done. G. So we're right on that same account, wages payable. That gets a debit, 38,300. G. And that's a credit to cash, 38,300. Are you guys looking closely at what I'm doing? Feel free to stop me if you see a mistake as I go. H, overhead, $2,800, and accumulated depreciation, which should be right near that. Right. That was H. I, we're getting there, close. Work in process, 12,750. And manufacturing overhead. That was the allocation, right? If you remember. When we moved it out of overhead into work in process. So you can see everything that's happening to each account in this ledger. Okay. J, finished goods. That's when the job 120 got completed. 47,800. J. And it came out of work in process. J. See, I put L here. That's really J, right? Okay. That could make it all. And the J and the L look so, especially when you wear glasses, right? That little, okay. K, accounts receivable, that's when we sold it, right? 111,000. Okay, and we got revenue, sales revenue. Oh, don't bomb out on me, okay. Okay. Sales revenue. Okay, now this is where we record in the perpetual method, right? So it's still going to be K. Notice how they use K both times, because it's really one entry. Cost of goods sold, that was job 120, and it's the same cost. And it's going to come out of that finished goods inventory, Well, one more. This was the accounting for the under allocation, right? So we're going to hit cost of goods sold with it. 8,300 L. And we're going to credit the overhead. So don't be too quick to hit enter or check, because what do we have to do? We have to get the balances. Okay, so this is going to be some arithmetic here. I'll add up my debits for cash. And I'm just going to go ahead and subtract the credits. Looks like I'll be more on the debit side. Believe it or not, this is where most of the mistakes are made, because we kind of put our brain on autopilot when we get to the point where we're adding and subtracting. And I'm doing accounts receivable now. Actually, this would be a good demo for accounting 202 as well. And then we get lucky sometimes. See, like property, plant, and equipment, you don't have to do anything. You just bring the balance down. Okay. Let's see. This one, look at that. Right? It just cancels. The 47,800 cancels out, so I'll just bring the 20,000 down. So if you kind of think like that, then I needed to do raw materials, so 56 plus. Don't give it an extra 0. You know, with your calculator, those of you that haven't used My Accounting Lab, you can, if you got a number you want to drop into a cell, just use this arrow and it puts it in there. If you're using this calculator. Okay, work in process. It is going to be more on the debit side, so we'll go ahead and go. And then I'll just subtract backspace 47,800. We got 35. Okay, we did the finished goods. We did that. Accumulated depreciation. It's just a matter of adding those two, so that would be 75,800. This one is going to end up with a credit balance, so I'll start with the 128. Add the 3,700 and subtract 40,000. Make sure you put it on the correct side. This one is a wash for the 38. Oh wait, be careful. There's a trick in there. Right? You see, this is 38,300 and that's 38,000. Okay, so you might want to go through the drill of and then subtract the 38,000. Or you could have just took 38,000 out of there. Okay. You know, I did something wrong, right? 38,300. Right, it's going to be 1,500. Should be, right? If you think about it. And then the rest, oh, I thought we would get lucky. But we still have to do a little more math. We'll put these in. So they only had 111,000 in revenue, one sale, but there could be multiple when you do another problem. Let's see, 56,100. That look okay? And this one's gonna be take care of the one here. And then we'll take care of this one. Okay, overhead should be 0. We'll redo the math, but it should come out to 0. Because the whole idea was that we took care of the under allocation, right? So when you think of it, and we did it in Excel too. Zero. Okay, and because they only give me a debit side, I'll put 0 here. And then you kind of hold on and squeeze and think, okay, I sure hope I did all my math right, posted right, and then you just go for it and and you feel good, right? It's like, oh, okay. Now they want us to get into the detail. Is this where you got stuck? Okay, okay. You got, okay. So let's read this carefully. Post the transactions to raw materials inventory subsidiary ledgers. Key each transaction by transaction letter and calculate the ending balance of each account. So we probably got to go back and look at our journal entries because, well, good, they give us the beginning balance, but that first purchase, let's check. Here, okay. So in the first purchase they bought, that raw material was broken down 26,600 paper and 4,100 indirect material. Okay. 26,6 and 41. So I'm going to put that. And 41. And I forgot the letter, so I'll go back up. That was transaction D. Okay, so I believe, wait, I'm sorry, yeah. I believe that's what they want in there, the transaction letter, right? Yes, D. Okay. So what we're really going to be looking at is when the materials get used or bought. Okay, so let's see what else happens here. Cash, raw material. Okay, here's something with raw material. Okay, so job, this is E. They used raw material of 9,950, right? And that was a combination of paper, which was 8,450, and indirect material of 1,500. Okay, so that's going to be the credit to the accounts. So I got to remember 8,450 and 1,500. And that was E at 1,500. You see what I'm doing? Does that make sense? It's getting into a little more detail of what's happening in that raw material account. Okay? And then we'll come back up and we'll just keep looking for anything that happens. Raw material. Okay. That's where we bought it. That's where we used it. This doesn't have anything to do with it because it's labor. Cash. Overhead. That doesn't have anything. Work in process. Finished goods. I think we're kind of done with the raw material account, right? We'll give it a shot. So we'll get the balance, and we got 47 plus 26.6 minus 84.50. Unless my eyeballs miss something. And then I'll get the balance here, so 5,000 minus 1,500 would be 3,500. You guys okay with that? Fantastic. So really what you're doing is you're taking care of that, the detail in the raw materials account. How much of it was paper, how much of it was indirect material. Now, let's see. Post the transactions to the work in process inventory subsidiary ledger accounts. Okay, so remember work in process is made up of jobs. This is job order costing. So we got a job 120 and a job 121 sitting in there. And we're going to key each transaction by letter. Okay, so the first time job 120, or the first time work in process is affected, that's the entry we want to be looking at. So let's see. That's here. transaction E. Okay. So it says, materials requisitioned and used in production. So job 120 is going to get 500, and job 121 is going to get 79.50. Okay. So let's 500 and 79.50, and that's transaction E, right? Is that right? Remember? We'll go back and look. We got to go back up there anyway. You know, because we're going to be looking for more work in process. Okay. So yes, E. So now I'm keeping track by job. Okay. So in this entry E, job 120 and 121 are the ones that are in work in process. They're the ones that receive direct material. Okay. Now they're going to receive direct labor. Okay. So transaction F, job 120 got 37.50, and 121 got 17.5. You know, and you know how I labeled mine, right? I probably would, for my notes in my head, I would have labeled what it was, okay, on the work in process. But over here, we're just using the reference letter from the journal entry. Okay. Now let's take another look. We went to F. G, there's nothing happening with work in process. Nor in H. Okay, I. I is when we absorb overhead. So we're going to have to do a little math. We've got to remember our rate, 60%. And we've got to remember that it's 60% of direct labor costs. So now we've got to go down into each job and look at the direct labor, which was F. So we have it sitting there in the T account down there. And take 60% of that for each job. You guys follow me? Stop me if you don't. Okay. Once it clicks, you're going to say, wow, yeah, that makes sense. Okay. So remember, when I put direct labor into each job, that was transaction F. And my predetermined rate is 60% of direct labor. So I'm going to take 60% of the amount that's associated with F for each job. So for job 120, 37.50 times 0.6. And it should come out to a nice number without any decimal. That's, I don't see that's how you can kind of tell you're right, but it'd be hard if we had to round, yeah. Sometimes it tells us to round though. Okay, 17,500 times 0.6 is 10,500. Okay, and that's the allocation. I forgot to note the letter in my head. Let's see. Here it is. Transaction I. Okay. While we're up here, let's just note transaction J is going to move it out of work in process. Okay. Let's see. Transaction I. Come back down here. Give it an I. Okay, now let's go to transaction J. It says jobs completed during the month. Only job 120 was completed. So only job 120 is going to get a credit. Job 121, it's not finished yet, so it's going to stay there in work in process. So 47,800. So job 120, 47,800. And that was J. So I'm kind of in a situation where I can take a balance. And job 120 should come out to 0 because it got finished. It got moved out of work in process into finished goods. If you're kind of, you just rely on yourself that way and you're pretty confident, you could probably just put 0 in there. But I'm going to subtract, I can tell, okay, it's already 0. I'll make sure it's 0 before I and then job 121 will just be the accumulation of whatever's on that debit side we get? 35,950. Now we gotta break it down. This is the part where it kind of gets fuzzy a little, but we gotta break it down into what's in finished goods. How many large stars and how many small stars are sitting in the finished goods inventory? Okay, so we gotta think a little bit. Because think about it, right? Job 120 went into finished goods and it came out of finished goods, right? See, it moved into finished goods, 47,800, and we sold it. So job 120 is not in finished goods. So I'm almost apt to just go into my trial balance, checking out what the beginning finished goods balance was, 20,000. Okay. The thing is, they want me to show the transactions, okay? So there's the 20,000 sitting there. Let's see what job 120 was about. Okay, see, job 120, the jobs completed during the month. Job 120 was just large stars. So there were 800 large stars at 47,800. So during the month, 47,800 large stars came in, right? And that happened in entry Yeah, J, you're right. Okay. See? I should have looked at it when I was there. Okay. J. So it came in J, and then when did it go out? It went out in K, right? So you're going to have a 47 coming in, debit, 47 going out, J and K. And if we do that, J and K,
So it's just the same balance.
it ends up being the same balance. Because remember, nothing else happened. Okay. So it's so simple that it might throw you off because you're thinking too hard about it. Okay. Everybody see that? So the combination of large stars and small stars subsidiary accounts is your finished goods ending inventory balance. And we'll pop that in there. Oh, okay. Great. But the nice thing about it is, in the past, I never really paid attention to this thing in the problems, is that you can pull up your trial balance here. Not your trial balance, but your general ledger, right? And you don't have to scroll back up. You saw that. So this is all the work we already did. And then it's just a matter of populating this and being careful that you're putting it in the right account, right? And then putting it on the correct side as well. So raw materials is 26,350. Work in process is 35,950. Finished goods is 20. Property, plant, and equipment is 230. Accumulated depreciation is a contra asset account, just for review here, and it sits on the credit side. But it sits there with the assets, and it's going to reduce that property, plant, and equipment directly. Okay. Accounts payable 118. Wages payable. Common stock. Retained earnings. Sales revenue. I'm just pulling it from the ledger and putting it into the right debit or credit column, just taking the balances. and cost of goods sold is a debit. Overhead should be 0. They probably want us to put a 0 in there. And selling and administrative expenses is 20,000. And then we get the test here is to make sure we're in balance. Okay, it's not gonna let me look at that's 20,000 at the bottom. Okay, let me add up the debits. Let's see if we got something we can. Okay. 7,800. Let's see if it's the same, and it looks like it is. Wonderful. Oh, here, got all that way. Okay, one or more of your debit balances you have entered are incorrect. So what it's saying is, refer to the T accounts you prepared above and enter the correct balance for each account. Be sure to leave unused cells blank. I think I know what I did. It didn't want the 0. It's an unused cell. Leave it blank. Okay. So sometimes you get it wrong and then you click it off real fast because you don't want to look at it. But sometimes it helps to read what the mistake is because then it tells you where to go look. Okay. And it was in that last sentence, right? So you kind of need to read the whole thing. Okay. Anyway, prepare your schedule of cost of goods manufactured. Okay. Right. So it's kind of a simplified cost of goods manufactured form. But what you always start with is beginning work in process. So let's see, beginning work in process. And they give me a T account. We started with 41,300. And then the 3 manufacturing costs are direct material, direct labor, and manufacturing overhead. That's something you want to kind of memorize. I believe I'm going to take a chance here. I'm not going to scroll back up to the journal entries, but I believe they are in the correct order here. Okay. So we're going to just use those numbers. This was the direct material used on the jobs. This was the direct labor. And the numbers look familiar enough that I think we'll be okay. And this was the overhead that was allocated to that job. So what you're going to have is what we call total manufacturing costs incurred during the month. And that's the subtotal of these 3. Okay. So you really have, it's kind of like a periodic method going on. Beginning plus what was incurred and minus what you have at the end. So I'll just add these up. And I believe that's going to end up being, 42,450. You add the 2 together, so beginning plus what was incurred, and that's going to be labeled total cost of work in process. Okay. Or in this case, they're calling it total cost to account for. And then what you do is you subtract the ending work in process inventory, so 35,950. And that's what we call cost of goods manufactured. I think I put a video in there on that too, on how to get cost of goods manufactured, and in a more expanded version. Okay. Now, requirement 5, make the income statement. Okay. So really, you know how to make an income statement. You're going to take sales revenue which was 111,000. Then you're gonna subtract cost of goods sold. And cost of goods sold is gonna be, remember, beginning finished goods inventory. So just treat it like accounting 201, but use the finished goods inventory account. And instead of purchases, you're gonna have cost of goods manufactured. And that comes from that schedule we just did. So I'm gonna put the 47,800, and then my beginning finished goods would have been on my beginning trial balance. Okay, so be careful, that's June 30. Here's June 1st. And it was 20,000 to start. You see where I got that? Okay. I think I can put away the beginning trial balance for now. So what I'm gonna have is cost of goods available for sale. Right, beginning plus what I made. We're a manufacturing company, so it's what we made, not what we bought to resell, but what we made. So I got 67,800. Then I'm going to subtract my ending finished goods. So that's going to come off my June 30 trial balance, the ending trial balance. Oh, to make it easy, huh? 20,000. Okay. So we're right back to where we began. Just double check that beginning from here. 20,000 on June 1st. 20,000 on June 30. Okay, well, if that's the way they want it, that'll be my cost of goods sold. Oh, wait, we skipped a step. Beginning plus cost of goods manufactured, cost of goods minus. Ah, what's missing? They want the cost of goods sold figure down here. For some reason, they got extra rows in the
trick.
Oh, remember we made that entry to adjust cost of goods sold, right? So we need to put that in there too.
That's the
Yes.
83.
What can we call this? They want that adjustment in there, right? We have a adjustment
Well, it's not under allocated.
for under allocated. Maybe I put it here. I'll put it here, okay. Where is my adjustment? It was back up in a journal entry, right? Yeah, that's why they give it to you here. 8,300, okay. $8,300. And then we'll call this cost of goods available for sale. Add those two, right? So we got, what do we got? 76,1. Does that look right? And then we'll subtract the ending finished goods, which is here, 20,000. We'll subtract it. Now I don't know if they want it in parentheses for negative, but we'll go 56,100. Should I? Maybe I should put it in parentheses since we're subtracting, okay. Right. And then we would take the revenue of 111 and minus the cost of goods sold to get my gross profit. Okay. And then we have some other expenses, I think one other, selling and administrative expenses, 20,000. So we got 34,900 And let's kind of look. Okay. I'm not I don't think they want us to show everything negative. I probably don't even need to show that finished goods, ending finished goods. Let's see. Okay. Make sure each line of the income statement is properly labeled with an account, subtotal, or total line. Recall the format of the income statement and try again. Sales revenue, cost of goods sold,
Maybe it's the cost of goods available for sale.
cost of goods. Yes, you're right. Because we made that down here, right?
Before adjustment?
There you go.
But I think that one has to go
Yes,
on the bottom instead.
down here.
Yeah.
There you go. And this can stay what it was, right?
Yeah. Available for sale.
Wait a minute. But the adjustment is up here.
Oh, yeah. before
Opposite. Opposite, right?
yeah.
So this is cost of goods sold before adjustment.
And then that's the available for sale.
Wait. Cost. I think the adjustment is going to have to go down here. Okay. Let's see. So if I make this cost of goods available for sale, and we make, here we'll do this. We'll make this the difference, cost of goods sold before adjustment. Wait,
That would be the.
we're going to make this the ending finished goods inventory, okay? Where's my, okay. So we'll put our ending finished goods inventory in here. And then we're going to subtract to get 47,800.
Oh, I got it.
Then we're going to put the adjustment in for underallocated overhead. That was 8,300?
Yeah. That's
Okay, yes. That would make sense. If it doesn't work out, we will just click. Or we could pull up the book. I think the proper thing to do would be to pull up the book. Let's see. The math should work out though. We just move some numbers around, right? Wait. 67 minus 20. This is double check. 47, 8 minus 83. 39. 8. Wait a minute.
What about that cost of goods available for sale?
Okay, let's see. Beginning plus cost of goods manufactured equals cost of goods available for sale, right? Minus ending finished goods equals cost of goods sold before the adjustment minus, no, add to the adjustment, right?
Yeah.
That's what we did, okay. So, 47,800 plus 83. 56,100. Okay. Well, let's see how we do. Minus.
Everything else is the same, right?
Yeah, everything else should be fine, right? 54.9 minus 20. Got it. All right. We did it. Okay. So be careful with that. We weren't thinking about the